Meet Jamie. Jamie did everything right, went to university, got a job, and started paying their student loan. And yet, their loan balance is higher today than when they graduated. How is that possible? Today, we're breaking down how UK student loans really work, why interest spirals, why so many graduates never fully repay, and what the new budget freeze means for millions of people. Let's rewind. Jamie is 17, still in school. No full-time job, no real understanding of loans or interest. They're told university is an investment in yourself, so Jamie signs up for a student loan covering tuition and living costs, often bigger than a first mortgage. No credit check, no upfront cost, no clear explanation of long-term consequences. Just future you will handle it. Student loans weren't always like this. Before 1990, students received grants, free money. Tuition was free or heavily state-funded. In 1990, the Student Loans Company was introduced to help with living costs. In 1998, tuition fees arrived and loans began covering both tuition and living expenses. Then, in 2012, tuition fees tripled and Plan 2 was created, shifting far more cost and risk onto students. Jamie graduated under that system. Jamie leaves university with £50,000 of debt. But here's the key thing most people don't realise. Repayments are based on income, not the balance. Under Plan 2, you only start repaying once you earn above £29,385 a year. You repay 9% of anything above that. It sounds reasonable until you look at interest. Interest is the real trap. For Plan 2 loans, interest is linked to inflation, RPI, plus up to 3%, depending on how much you earn. That means interest rates of 6 to 7% are common, and crucially, interest starts building from day one, even before graduation. So by the time Jamie earns their first payslip, the debt is already growing. Plan 1 loans work very differently, with much lower interest, but Jamie never had access to that option. So then why choose Plan 2 specifically? Because Jamie didn't really choose it. If you started university in England after 2012, you're automatically placed on Plan 2. There's no menu of options, no comparison, no warning that this plan works very differently from older student loans. Jamie earns £32,000 a year. They repay around £30 to £40 a month. But every month, £150 to £200 of interest is added. So even while paying, the balance keeps rising. Now add another problem: wage stagnation. Graduate wages haven't risen anywhere near as fast as living costs, housing, or inflation. Entry-level jobs pay relatively less than they used to, competition is fierce, and many graduates are underemployed for years. Jamie did what they were promised, got a degree, but the salary growth never arrived at the speed they expected. That means repayments stay low, while interest keeps climbing. This is how things often end. Jamie keeps paying for decades. The balance barely falls. And after 30 or 40 years, whatever remains is written off. Jamie never actually pays off the loan. This is why many experts say UK student loans aren't really loans at all. They behave more like a graduate tax. You pay based on income, not debt. Interest keeps growing in the background, and repayment can last most of your working life. Who does this hit hardest? Low earners often repay very little and see most of the debt written off. High earners clear the loan quickly and escape the interest. But middle earners, people like Jamie, repay for the longest during years of stagnant wages and rising costs, and often pay the most overall. And now there's a new twist. From April 2026, the Plan 2 repayment threshold will stay frozen at £29,385 until 2030. That means more graduates start repaying sooner. As wages rise slowly, repayments increase in real terms. Critics call it a stealth tax. The government argues graduates earn more over their lifetime, so they should repay more. For Jamie, it means paying more earlier, even if their living standards haven't improved. So, is the UK student loan system broken? That depends on what you think it's meant to do. If the goal is to get more people into higher education, then it works. Millions of students can go to university without paying anything up front. But if the goal is transparency, fairness, and informed consent, that's where the system starts to fall apart. Most students sign up at 17 or 18 with no real understanding of compound interest, inflation-linked rates, or how long repayment can actually last. The language makes it sound like a normal loan, but it doesn't behave like one. Repayments are based on income, not the balance. Interest keeps growing in the background, and many borrowers were never realistically expected to clear the full amount. Add in stagnant wage growth, rising living costs, and lower real pay for entry-level graduate jobs, and the maths gets worse over time. Graduates are paying more, for longer, while feeling no closer to being debt-free. That's why critics argue the system isn't broken by accident. It's working exactly as designed. The government recovers more money from middle earners over decades, while keeping upfront university access politically acceptable. So the system functions. But whether it's fair, clearly explained, or still fit for today's labour market, that's the real debate. Before you go, I'm Max. I break down UK money, tax, and financial systems. Simply, honestly, and without the boring jargon. If this helped you understand the system better, follow for more UK tax traps, money myths, and things no one explains properly.